I think we're live. Welcome everybody to the latest Pillar webinar, Top Strategies for Crypto Investors. My name is Aldin Ademović. I will be your host for today. Just a quick reminder that none of the statements in this webinar should be construed as financial advice. We are simply sharing our strategies with you. I have a great set of panelists on our show today with wealth of experience, and I'm ready to introduce it to you. I'll first introduce Amber Ghaddar. She is one of the founders of AllianceBlock, the blockchain startup building the framework for the world's first globally compliant capital market by bridging traditional finance and DeFi. The startup was formed in 2018, has received funding from the likes of Binance DeFi Fund. AllianceBlock ranks globally in the top 200 of blockchain projects by market cap. Prior to AllianceBlock, Amber was a bond trader at JP Morgan in London, where she held various leadership positions. Welcome, Amber.
Thank you. Thank you for having me, Aldin.
Great. Our next panelist is Efi Pylarinou. Efi Pylarinou is a global fintech and blockchain thought leader, a well-seasoned Wall Street professional with over 200,000 followers on all social media channels. She joins us from Switzerland. She has her own advisory company where she creates content for her clients' campaigns. Blockchain for finance is one of her areas of focus as it disrupts capital markets, asset management, and payments. Welcome, Efi.
Thank you. Thank you for having me.
And our last panelist is Toby Lewis. He's the founder and CEO of Novum Insights, an analytics platform. He's a repeat entrepreneur and a well-known analyst in the fields of blockchain and artificial intelligence, fintech, and venture capital. Novum Insights is a trusted advisor to family offices and high-net-worth individuals and who are looking for exposure into crypto markets. Welcome, Toby.
Thanks, Aldin, for having us.
Great. I'll start with the first question to Efi. Innovation funds like ARK by Cathie Wood has been very successful in betting on the likes of Tesla and Zoom. And you yourself, you come from a traditional Wall Street background. How do you see crypto fitting in the traditional portfolio allocation and the innovation narrative?
Thank you for the question. I think it's important to start with a traditional framework just because it is a framework, and it's important when investing to have guidelines, an investment thesis, a risk management style of thinking, and I think that holds for any asset class, included this emerging asset class, the cryptocurrencies and the digital assets that sometimes resemble commodities, sometimes resemble other assets that are more complicated. I would call them sometimes the next generation of structured products. So when I think of a portfolio and what asset allocation one should follow, I always make it clear that whether it's cryptocurrencies or other types of exposures to the blockchain space, they should fall into your allocation to innovation. And if you are the type of investor that wants 100% allocation to innovation, then that's how you should go about it. But you can be, and most probably you are an investor that has a much lower percentage of allocation to innovation. It can be 60% or 40%, because we live in a world where the old sort of thinking of equities versus fixed income moving in opposite directions doesn't hold. So we are all looking for assets that are uncorrelated, and this is one of the thinkings with the crypto world. I'd also like to emphasize that when I'm thinking of portfolio allocation to crypto, I'm also very much aware of the fact that cryptocurrencies are sensitive to narratives, and narratives that are changing, and therefore they may behave differently in a portfolio context. And I think we'll have the opportunity to talk about that more with my co-panelists about what are the narratives that are dominant right now, how they've changed over time, and how they may change going forward. And of course, the typical example is the example of Bitcoin, that a lot of investors think of it as digital gold, but it can be changed, and it is changing right now because some countries are adopting Bitcoin as legal tender. So how does that change the narrative of Bitcoin? So these are some thoughts that I'd like to elaborate later on and give it over to you, Aldin, and to our other panelists.
Excellent. Thank you for that, Efi. My next question is more to Amber. And considering your background in trading, and a lot of new investors that are coming to the crypto space have an experience with exchanges that offer advanced tools in the form of derivatives, options, and futures. What advice would you give to investors that have the first taste of this kind of exposure, which are more aimed for short-term gains over long-term exposure, like just a buy and hold position? Would you recommend they get educated on this? Would you recommend they participate in these kind of options that we have?
So first, I just want to come back on something Efi said with regards to the allocation to innovation, which you can look at cryptocurrencies within your innovation allocation. But the way we look at it is, for us, crypto assets, not cryptocurrencies, because they are not currencies in the pure definition of the term, crypto assets have a real place in your alternative allocation. So within your portfolio, usually funds will have somewhere between 5 to 30% of alternative assets. These alternative assets can be hedge funds, can be commodities, can be real estate. Usually they have 4 main roles. So they're either for capital growth, either for income, either for diversification, or for hedging. For example, Bitcoin is a great example of capital growth assets. As you know, Bitcoin performance versus equity performance or versus bonds performance is humongous. And Bitcoin is also a great tool, which has been proven in the last 2 days, is a great tool for a hedge against systemic risk, especially a systemic risk in the United States with regards to the Fed or with regards to the US government. I just want to highlight another point that is quite interesting. We have actually seen correlation within crypto assets being quite high, disappointingly quite high with risk on assets. So you would be able to trade the market just by looking at what's going on in growth equity or in tech equities, in tech stocks, which has been disappointed for us because we believe that this asset class should be uncorrelated. The great thing that happened the last 2 days is you have the debt ceiling discussion in the US, and suddenly what did we see? We saw Bitcoin just zooming all the way up. So that's a very interesting point that actually confirms what we said, is that Bitcoin is not a hedge against inflation. Bitcoin is actually a hedge against a systemic risk in the systemic risk for the USD and for the Fed. For the US. In terms of derivatives, I think there's a very important point or very important number people should remember. 80% of retail traders lose money in the derivative space. Derivatives are not as simple as exchanges let you believe they are. And one thing we need to remember when you become a trader in an investment bank, usually it will take you 3 to 6 months and a plethora of exams that you take with the FCA in the UK or the SEC in the US before clicking the trade button. Yeah. They teach you how to manage risk. They teach you what are these derivatives, how they behave, how they perform. And it's not something that you can learn in 1 day or 2 days. Derivatives are great in some way because they allow you to trade with leverage, and trading with leverage, if you're a good trader, can allow you to make a lot of gains, but at the same time, you can have a lot of losses. So my advice for anyone who wants to trade derivatives, whether it's futures or option, to really take in-depth courses about what these products are, how they behave, what are margin calls, because you'd be surprised the number of time you see in these social chat like Reddit and subreddit, people being surprised, oh, where's my money? It's gone. Oh, bah, you've been margin called, yeah? And understanding also within the crypto space, you have a lot of different exchanges. Each exchange has different processes for these margin calls and for the liquidation events that would follow if you do not fill up your margin. Otherwise, I would say if you're good at trading and if you're familiar with options, there are a lot of great trading strategies in crypto space because volatility is so high, where you can sell volatility. So you can sell out of the money calls, delta hedge, and just monetize this implied to realize, which can go up to 4% per day. It's huge, 4% per day compared to traditional markets when it's like 4% per 3 months, right? But again, you need to go through the education process and you need to go through the training process.
Yeah, I think the risk management approach is quite key with whatever you're doing in crypto and how you position yourself. Thank you for that, Amber. For Toby, I have a question. As a trusted advisor that you are for many family offices and high net worth individuals, and they're trying to make sense of this space, and they see a lot of options to them, from NFTs to meme coins, etc. Like, what would you recommend as a first-time investor, like regarding research, and what would they potentially should be looking at?
Yeah, no, 100%. So we typically work with those kind of clients by understanding their risk appetite, what kind of exposure they want to the asset class. And I think clearly the core holdings, without a doubt, are sort of Bitcoin and Ethereum, and then you should begin sort of looking at what different levels of exposure you want. And I think for many the sort of DeFi elements and these kind of things are already getting quite exotic, but it's also what people want to sort of, if you're sticking your toe in the water into what you're doing in crypto, playing around with that decentralized space is very, very interesting and has lots of intriguing elements. So we often sort of help people assess where they want to go there. Then you have sort of, I guess, massively trending areas. You mentioned the NFTs. That I find very, very interesting because it's kind of very intuitive to consumers in the sort of their images, things they can access. It's much better than trying to understand what a DAG or a parachain or any of the sort of, I guess, the complex nuances of wider crypto. It's also, though, a very irrational sort of part of the crypto asset space, and has been probably the highest returning, other than some of the derivative strategies that Amber was talking about. But in terms of sort of buy and hold allocations in recent months, it's been very high returning. But then it's a classic kind of bubble hyped market where there's extremely limited fundamentals behind it, other than some sort of games of scarcity and some implied future use cases. But I think we've always talked about the returns available in DeFi and Aave and Uniswap liquidity provision and these kind of things. And what's really interesting is right now you can probably get 1-2% in the high yield in the bond market, and then in the high yield a bit more, with an understanding of how you use the different sort of Aaves and Uniswaps and the like. You can get 8% or more for some very seeming low risk strategies. But as we saw, Compound, for example, had a bit of a issue last week where funds were sort of popping up in different areas. So I think that the key for anyone to remember is that even those kind of strategies are not risk-free, and it's kind of software and happens in a decentralized manner that can have quite strange results.
Before we get into NFTs, I have a question for the panel. There's a huge rise, or particularly this year, a huge rise at the beginning of the year regarding meme coins, like Dogecoin. You see Elon Musk backing it. You see like tokens like Shiba Inu that literally have no solid fundamentals, appreciate very rapidly. And my question to all of you is like, is it worth as a serious investor to get in on this? Because it seems to be a joke, but then the profits are actually real. So maybe what would you say, Amber?
Well, I got into it, yes. At first, like I was reading and I was like, impossible. And there was like the Dogecoin, and okay, Dogecoin, maybe it has like some background because it derives from Bitcoin, and you can always find some solution. But there were like some coins with horrible names that were very successful and that were only being pumped by Elon Musk. I wouldn't put 5% of my allocation in there. But yes, I remember very strongly that Toby and I were awake when, Elon Musk was on Saturday Night Live. And I remember that thing went to 75 cents before the Saturday Night Live. And we were like, okay, short now. And in some way we were right. And we made quite good returns. So sometimes, in crypto, you have two ways of looking at value. You have fundamentals, and then you have sentiment. Right now, sentiment drives more than fundamentals because a lot of these products are not live yet. A lot of these blockchains are not live yet. A lot of these layer 2 protocols are just coming live. So it's all about expectations and forecasting potential future use. But what I say is, I think it was 2 years ago, 2 years ago, Tesla was trading at 1,000 PE, 1,000 price to earning ratio, at a time where they had no profit. And they were trading at 1,000 PE. Why? Because people believed that they will be able to deliver. So sometimes in the crypto space, people believe that the Solana were going to deliver, that Cardano was going to deliver, that Polkadot was going to deliver, and they put these huge valuation on these assets just based on sentiment, and it works. And if you're a good trader, you should be able to play both sides. You should be able to look at the fundamental, but it's not just math, because trading, unfortunately, is not just math. Because if it was just math, I think algos would win at every time, and they don't. It's a lot of getting a feel for the market and getting a feel of what's the sentiment in the market.
How do you, just to stick to this, how do you judge the feeling of the market? Like, do you keep on Twitter, follow certain people? Like, is it discussions with other people, like Toby, for example? Like, what would be a new investor? How would they go about this?
So there is, of course, the Twitter feed. So, for example, we noticed the moment you have a lot of short Bitcoin mention on Twitter, it means that you're reaching a bottom. We've also noticed that when everyone is buying that means you're reaching a top, and you need to be careful. But there's also what we call on-chain indicators that are very good to give you a good feel of the long-term sort of direction of the market, where you look at behavior of miners on-chain, behavior of long-term holders versus short-term holders, and number and volume of transactions. So there's a lot of indicator in the on-chain space. I'm not going to go into there because it needs 1 hour just to go through them all. But yes, on-chain has been quite good. And then more for like medium-term, long-term trading. And I would say for short-term trading, crypto is one of, I would say, the only asset class where technical analysis becomes a self-fulfilling prophecy because everyone uses it. So you can look at your moving averages, you can look at your unbalanced volume, you can look at your RSIs, you can look at, Fibonacci retracement, Bollinger Bands, and the rest. And if you're good at it, and keeping in mind it's more an art than a science, technical analysis, you can have a good feel of where the market is going.
Interesting that you consider TA as market sentiment. I never took much value into TA personally. Efi, do you share the same sentiment as Amber regarding meme coins and like all these tokens that basically have no fundamentals and are just promising something or lack of not even promising anything, just being a joke as Doges?
I think this is symptomatic to the fact that the cryptocurrency market is really open in a way that no other financial market that we know is. It operates 24/7. It operates on central exchanges, on decentralized exchanges, and peer-to-peer exchanges. We don't have anything comparable, in the rest of the assets that we have in our portfolio. And as a result, it's natural that it will be more sentiment driven, or more often we will see this self-fulfilling prophecy to be realized. So I'm not surprised. I'm also not surprised because right now most of the volume of transactions is dominated by the investment world, be it retail investors or institutional investors, funds and so on, and not by real use cases. And what I mean by that is there are Nigerians using Bitcoin because they need to do import-export trades. They can't get access to US dollars because basically the government holds the US dollars, and they're using Bitcoin in order to do their import-export business because nobody will accept their currency. So that is a real use case. But that's a small part of what is happening, and it's not the reason that Bitcoin is appreciating because these Nigerians, this is an example, but it is a real example. So again, I see it as symptomatic of this open source financial market, if you want. Think of it, we have an infrastructure today on which open marketplace trading can happen with these cryptocurrencies, which we didn't have before. So we'll be surprised by all these issues that are coming up. I also want to add to what Amber said about risk, that there's the market risk, of course, but there's also the operational risks that are very important for crypto investors. And that's more, close to the risks that we saw with Compound. And I think all investors should not underestimate the operational risks that exist in this market, and they should educate themselves and understand, what is a self-sovereign wallet? How does it work? What is the other wallet? How do these stable coins that are collateralized with, whether it's DAI or other algorithmic stable coins, how do they work? So these are operational risks that you need to understand.
Which brings us to a good point. I don't know, Toby, if you want to chip in on this. I have another question for you. Like a lot in the space is also always being mentioned to the new crypto investors, like do your own research, How would you go about doing your own research? What would you advise? What should you look at if you're looking to invest in an asset or in a brand new team that's launching, for example? Is it simply the tech? Is it the people? Is it the new layer of blockchain, etc.? What would your recommendation be?
So I think historically the greatest value has accrued to crypto projects with network effects, basically. So I think sort of that's the key sort of, I guess, thing which you need to figure out. And there were quite good studies in terms of sort of how the sort of network around Ethereum was growing much faster than Bitcoin has been in the last year. So at the similar age of its trajectory. So Bitcoin came out in 2009. Ethereum came out in 2016, and if you map the trajectory of the adopters of Ethereum, just because you can do so much more in the Ethereum ecosystem and the different layers around it. So I think the network is really, really interesting, and that's what fascinates me about the NFT market. Is it has this sort of huge gravitation of people because I think it's easier to understand for many people. But then you can look at, say, Solana, that there's a lot popping up there, and people. So begin studying where the people are moving and what's driving that, and I think to a certain extent, Doge, there were a lot of adopters of that. So you want to look at how, I guess, decentralized a market is, how it's preferable, like Bitcoin and Ethereum are very, very decentralized markets. A lot of the other protocols or other things have significant holdings by different people. So we actually studied, we spotted Shiba Inu token, and Aldin and Amber will remember we were discussing Shiba and the related dog tokens in April, March, and we'd actually had this on our radar going up 10,000%, and I think every single one of us just assumed it was some form of scam and would fizzle out. But our indicators just kept on going. This thing was red hot at that time, and Elon pumping Doge as well sort of pushed it even further into overdrive. But there were a lot of people gravitating around Shiba and these related things. It wasn't, but then we looked into it, and Vitalik Buterin's wallet, we identified about 2 weeks before he left, held more than 90% of the liquidity pool on Shiba Inu, and then he sold his tokens to give to India. So I think you need to look at who's behind a particular market and why. And I don't think Vitalik in this case, he tried to do it quite benevolently. He donated his tokens to a foundation in India and was quite close to the founders of Matic and the like. So but there was a lot of risk in that market. But to a certain extent, you can study all the different markets. The great thing about the blockchain is every single holder is pretty much available, at least in terms of where the wallets are, where the risk is. But saying that, for example, Solana has been an extremely hot project. It is well known that roughly 50% of the insiders there held the Solana tokens. So it was there can be the tech factors and the reasons for outperformance can still outweigh the fact that a lot of insiders have significant advantage. But you have to be aware of that in any crypto market you're going into.
Solana is a good example of a project that came through Launchpads, which is quite big in our space. They tend to outperform the traditional buy and hold strategy if you go through a Launchpad that is on Solana or anywhere else. Now, for everyone on the forum, have you personally participated in any of the sales in Launchpads in particular, or gotten into a project that you thought was interesting?
So I recently got involved in a Lion DAO group, which is, I guess, trying to get rid of some of the problems around Launchpad. Well, I find it a problem, right? Because I don't want $300 in anything, right? Like it's just too small an allocation for me to care about. And so the problem with, say, the DuckDAO or Polkastarter or many of these other launchpads is you get such a tiny allocation that it's kind of interesting for a turn the market. But we do, I do like investing pre-sale to things going into a launchpad, and I think there's a lot of value in the crowd and that element. So what the launchpad achieves is it gets it into lots of different hands, but I think it's just the way these things are run. Often the allocation, like someone in our in the Novum group where we chat about these things was in Star Atlas, which did fantastically well, and he had a 200x. But I think he only managed to get like $100 of allocation to Star Atlas for his 200x. So it's kind of, it doesn't move the needle if you're allocating more capital, right? So but they're really good. They decentralize holdings significantly. There's a degree they can pump and dump things as well. So you can sometimes have huge run-ups and then the project disappoints. So they're very some of the elements of launchpads, they're great in that they get the hands of the thing into lots of other people. I in some ways prefer the airdrop strategy where effectively you get the project into the hands of a lot of people, but without such a sort of I guess hype cycle.
Before we get into, I just want to ask the same question to Amber and Efi. Like, when you do your own research, how do you do your research on a project? If you're looking to invest it or a particular asset, what kind of aspects do you look at?
So I mean, I would agree with Toby. I really like investing early stage, pre-seed, seed, ideally. However, I disagree. I think the launchpads are good in terms of allowing people who do not have the connection into these, early investor groups to participate a little early stage as well. So I think in terms of democratizing investment, I think launchpads are good. In terms from an investor perspective, yes, of course, the earlier you can get in with the biggest ticket you can get in, the better it is. Now, in terms of due diligence, I look quite a bit at the team, and then I look at the use case of the protocols. So there's one thing that I've noticed. There's been a lot of copycats of various projects on other blockchains. So things that you have on Ethereum are being copied on the Polkadot and being copied on the Avalanche and being copied on the Solana. You'd be surprised that it's actually quite, these types of products, especially if it's the first one coming out, it's usually quite a good investment because it will be the first product on the new blockchain doing whatever, being an exchange or being an analytic tool or the rest. And then there are the little hidden gems of very complicated products where you have amazing teams with a lot of experience that are building, things that will only come live in 2 or 3 years because it takes a lot of time to build them. So that, I'd say it depends. It really depends on what you're looking for. If you're happy to wait for 2-3 years on one of these super exotic projects, then yeah, it's a good investment. You allocate a percentage of your early stage portfolio there. If you're looking to make a quick buck, then I would say the launchpads are not bad because you go. Usually they will IDO after 6 months or somewhere around there, and then you can monetize it if you really don't believe in the project or you just want a quick return on your investment.
Yeah, no, and I would chip in. I do think they are yes, and they do provide more access to more people. I just personally, I just find the process very, very difficult. So I get into sort of fiddling around for the DuckDAO or whatever it is for $500 of allocation. Just is the effort involved I find tricky, but I can completely see the value they have in the market.
I want to give the word to Efi as well.
Yeah, I mean, for me, what Toby said is true. For me to be able to invest in an early stage project, the time I need to put in to do the research, it's just not worth it. So I'm starting to be more comfortable with the idea that I would like to allocate to a robo advisor, if you want, in the DeFi space. And there are some already out there that do a much better job, because this market is more sentiment driven, and also there's a lot of arbitrage opportunities that, as an individual investor, it's difficult operationally and risky operationally to take advantage of. So for me, it's kind of an allocation to large caps, if you want, and there it's much easier to do your own research to see, amongst the, let's say, top 50 large caps, what makes sense and what kind of exposure you want to allocate to, and then go to either an index or some robo for the more emerging ones. That's kind of my approach.
I want to stick with you just for a second, Efi. In the grand scheme of things, like NFTs have been blowing up, literally overtaking most of the activity that's going on Ethereum, hiking up the gas prices. Everybody wants in. However, there's I think recent research from Bloomberg showed that 75% of all the NFTs that have been bought are illiquid. So it makes a very risky strategy. But looking back a little bit, regarding the future, where do you see NFTs heading, and do you think it's worth a chance to become a substantial part of your portfolio as an allocation as well?
For me, I don't have the time to do the research to put it in my portfolio. However, I do see the value, and I want to get exposure to the marketplaces and those that are providing the infrastructure. Because, if I think of it, even in the traditional markets, in the tech space, broadly speaking, the tech space, whatever it is, e-commerce, whatever, it's the platforms that have the high PE ratios. So in the same sense, we are seeing, it's true also in this more open source space. It's where the network effects are. So whatever happens with NFTs, in my opinion, they're not going to stay in the art world as they are now concentrated. They're going to move on and mutate in other areas. It might be, I don't know, in marketing strategy. It might be, in areas that I can't even think of right now. So I would like to be able to gain exposure to those that have the infrastructure, the enablers, and are creating the marketplaces.
Thanks. Toby, do you agree with that? Amber as well?
Yeah, no, it's a really, really good point. I definitely, on the NFT space, that was my early play in it. So the one flaw with the play is the by far the most successful exchange in the space is OpenSea. And it is if you're not Andreessen Horowitz or one of their LPs or whatever, it's pretty hard to get in there. And we may well one day see an OpenSea even IPO, if not a sort of Uniswap style token sale. But and it must be so profitable, because they're basically taking 2% plus on every NFT sale and have about 30 people. So 100%, I'm sure it's one of the most profitable parts of the space. I mean, I love going into all these fragmented markets and trying to figure them out. And I'm just intrinsically an early adopter. So started buying up. Sadly, I got into the NFT tokens early in the year, and then gravitated towards the NFTs over the summer. And there's a lot of interesting dynamics, right? So you've got things like NFTX, where there's attempts to create indices of particular things, so you can own 0.2% of or 0.02% of a CryptoPunk, rather than owning the whole thing, which is extremely valuable, and you're competing with Visa to buy these kind of things, right? So and then in terms of the liquidity point, I think there's a very interesting dynamic to the market. So a lot of the sort of core NFT collections are 5,000 to 10,000 pieces, or you have individual artworks. I'm sure the individual artworks are extremely illiquid and very taste driven, and you're needing to be kind of a curator in these kind of Bored Ape Yacht Club, Mutant Ape Yacht Club, and further down sort of the scale. What's quite intriguing about these 5,000 to 10,000 piece collections, and been studying the market quite a bit, you only need 100 daily buyers for the floor to pretty much renew. So essentially you do have more liquidity than is intuitive. So I kind of view it a bit like buying a house in the Hamptons, buying a house in Chelsea or whatever, right? There's a limited market of people who want these things, but then there's enough people that see the value in it, that it retains its value, which is really intriguing as a sort of, I guess, an exercise in game theory.
Amber, have you gotten into NFTs yourself as an investment strategy? Oh, you're muted, Amber.
Yeah, I mean, NFTs are very interesting because it's let's say for the older generation, it's a change of paradigm. And for us, I mean, sometimes you read people going like, yeah, this JPEG, saying it laughingly or sarcastically, this JPEG is worth $50 million. But those of us who grew up with video games, we remember buying, the suits for the armors on World of Warcraft and the rest. So we're familiar with these digital items that have an intrinsic value that you can sell to another player at a higher value. So there's a real change in paradigm in what the meaning of art is, and that digital art is actually art. And I think one of the best analogies that I have found, because I find it very difficult to invest in NFTs, because most of the time my personal taste is against market trends. So I like the ones that are not popular. But usually I say it's exactly like buying a Hermes bag. So Hermes is a very famous French company, leather company, and they have these bags that sort of like all look the same, and they've been there since like the 50s, that same type of bag, and people buy them as an investment. So you buy them at between $10,000 to $100,000, and then depending on the rarity, so if it's crocodile skin, orange crocodile skin, a brown ostrich skin with a little ribbon, depending on the rarity of the bag, the price moves up throughout the years. And a lot of people buy them in their collectible allocation in their portfolio, so they just deposit them at a bank, in a deposit box and leave them there. And for me, this is what NFT in some way are, right? So you have the Hermes that go up in value continuously. Then you have let's say the Louis Vuitton. Every season you have a new bag, and then its price is here, but then with time the price goes down. And going back on the analogy that Efi gave, so yes, NFTs can be a bag, and then the company or the OpenSea and these platform can be actually the Louis Vuitton stock, right? So you're buying into the future of luxury goods by buying the stock of Louis Vuitton, and you're buying a store of value and capital growth when you're buying your Hermes bag. So yeah, that's my point of view.
I have to confess.
Can I add to this, because this is interesting? I mean, I love the bags analogy. The question then arises: what about the experience? What new experiences can be unlocked with these NFTs, with these handbags. And there's many. I mean, my mind is limited, I think, but still I can think of some that don't exist. I mean, we could have gotten together this evening if we had a collection of NFTs and had a private digital party, right? And there's so much more. And then we could rent out this digital party or invite others, limited invitation. And it could be some type of hybrid experience. So I think that this is the very beginning. We'll see what happens.
Yeah, no, 100% true. And I actually recently bought a mutant ape to join a so-called mutant DAO, where you have parties in the metaverse, and they're developing games, and they're also creating sort of liquidity provision and related tokens, and the creativity of crypto people is endless, right? So it's sort of so if you get in the sort of right one, it can be really intriguing if you're into trying to figure out what this thing does, right?
I've tried yesterday to buy my first NFT, and unfortunately, because the gas prices went up to $1,500 at the time, I've declined after all. So I'm not yet into the whole NFT thing personally. But great, we're almost running out of time. We're about 15 minutes left. I want to get into just a very simple question. What is the optimal, division between a portfolio when we look at Bitcoin, ETH, Solana? Like, Toby, what would you say, including NFTs? What would you say percentage-wise? How would you allocate it?
Yeah, no. So I think, and we've literally been putting together a study that this is kind of what we're providing as a sort of early product, that we're finding that there's a lot of people looking at this, and we're debating and modeling. My analyst, slightly bizarrely, decided to put a higher allocation for Solana than Bitcoin and Ethereum based on the data and fundamentals, which does make sense in some ways. I think there's a lot of intrinsic risk in those kind of things, but we looked at it on a protocol level. I think Efi makes a very good point on the sort of exchange governance tokens. It's often hard to distinguish the value in a Sushi or a Uniswap or a Symphotex and how you might value that, but intuitively they're good areas to hold, and similarly a Rarible. I think all like I've certainly over-indexed on NFT lately, and I'm rapidly trying to sell that position, but as Aldin points out, it's illiquid. But what's nice about the game is you can multiply a lot of ETH, and then my goal is to basically have more Ethereum than I put into the NFT market by the end of this month. So then I can at least feel that this slight experiment in market momentum has that's very much for people with a higher risk tolerance. I think that there's any number of these things, right? Like there's the data plays like Chainlink and elsewhere, and obviously AllianceBlock's got various of those angles covered. And I just think just keep a sort of constant ear out for interesting trends and where they move, and the space moves very, very fast. So if you can find yourself massively off trend unless you're keeping in day out, week in, week out. And Aldin, for example, has been calling the NFT bubble about to pop for ages, and it's very sensible because it will pop at some stage, right?
There was more of a question for you, Toby. It's like, so what do you say? Is it 20% BTC, 30%?
Yeah.
What are we talking about here?
Yeah, no.
Putting you on the spot. I'm sorry.
Yeah, no. Yeah, so yeah, I'd say 20% BTC, 20% ETH, various different outs and exotics. Right.
Okay, that's great. Same question for Amber. What's your position in this?
So it really depends on your investment horizon and on your risk profile, right? So let's say if you want to invest, you just want to have crypto for like 1 year, and then your breakdown, your portfolio allocation is going to be very different. And if you want something to preserve your wealth, then the portfolio allocation is going to be also very different. But I would say in general, for someone who wants a little bit of wealth preservation and at the same time good capital growth, the way I look at it is always keep 10 to 20%. So 10% in bull market, 20% when markets are starting to be bearish in cash and cash equivalent. What I call cash and cash equivalent are stable coins, whether they are algorithmic stable coins or stable coin backed by USD, and at the same time USD, GBP, euros, whatever your main currency is. And then I don't really think in terms of Bitcoin and ETH. I think in terms of blue chip, so layer one blue chip token, and for that you can have between 30 to 40%. And then same thing, you have the layer two, where you can also have between 30 and 40%. I would say 10% for NFTs, and then 10% for the small cap. So the small caps that I really like are these small caps that have very high yielding staking pools or liquidity pools with rewards on top of it, and in some way it can hedge the risk of the token going to Nile. I mean, some of them will pay you between 30% to 100% per annum for either staking or putting them in liquidity pools. So even if the token price goes down 50%, you're roughly still, you're still in positive PNL. So I like those. I also like to put all of my cash allocation into staking pools. So, right now you put your money at the bank, it pays 35 basis points. You put your money in USD stable coins, you put them on some of these Curve and Compounds and Aave and the rest, you can make between 2 to 12%. Keep in mind that, as Efi has highlighted, what she calls operational risk, I call security risk. So indeed, you have a security, you can look at it as a credit spread. So it's a security spread, and you need to make sure that this spread is lower than the yield that you're generating. So for me, I only invest in USDC, USDT when I'm getting roughly 10% per annum, because it covers, in my view, the risk of having a security failure.
Well, I'd like to add to that, Amber, and one thing that is, common sense is use multiple providers,
of course,
for staking, because then you're spreading your risks too.
Yeah, definitely. Don't put all of your eggs in the same basket. If you have self-sovereign wallets, non-custodial wallets, make sure that you have multiple wallets. Make sure that your codes are encrypted somewhere on an email where you know what the encryption to unlock the code is. There's the number of horror story of people losing a code that they wrote on a book and having, oh my God, I have 50 million bitcoins, 50 million equivalent of bitcoins in a wallet that I've lost 5 years ago. So you don't want to fall into these horror stories.
Educate the family members that are not in the crypto space, so in case something happens to you, they know how to decode whatever needs to be decoded.
And I was going to weigh in on that point. Actually, I think it's suddenly what makes me bullish on the layer 2s and other protocols that aren't Ethereum is that to actually get the real returns from the Aave and the Uniswaps and the equivalents in terms of you need a lot of capital just because of the gas price to be able to get that 8 to 10% return. So it sort of intuitively it makes sense, be it Solana or Polkadot or wherever, that someone will be able to create the ecosystem for being crypto to democratize it a bit more, right? Like you want the kind of safe returns that managers of capital can get in Aave for someone who's got $5,000 that they want to be parking, right? But the gas price on Aave, if you're just putting $5,000, would wipe out a year of the savings that you're going to be making. So but it is a critical part of an allocation.
Looking at I'm looking at time, I just have one final question for you guys. Obviously, we've discussed NFTs, other layer one blockchains, Cardano, Avalanche, Solana, for example. Is there a particular new vertical that you guys have heard of that you would be, excited about of investing? Like, personally, for me, it's cross-chain and privacy projects. But I'm keen to hear from you if you have any particular vertical that you think might be exciting for next year or the end of this year.
I'll go ahead. So I think one of the coolest products that we have at the moment on AllianceBlock is the bridge, which basically to allow interoperability between different blockchain. And the great thing about having just one bridge to rule them all is that usually bridges are between 2 blockchain, maximum 3 blockchain. So you need to jump from a burger swap to like something else. And the great thing about our product is that right now you have 4 blockchains, and we're keeping on adding the EVM ones and soon the non-EVM ones. In terms of products, I'm a big fan of synthetics. So looking very deeply into synthetics protocols, I think they have quite a good forward, keeping in mind that the derivative space in DeFi is still very, very small compared to what we have in CeFi, and it's definitely meant to boom.
All right, thank you. Efi, do you have anything that's exciting you?
For me, liquidity providers, those that are in that space, I think there's a lot to be done in that space. And I'm excited. We have a few companies here in Switzerland that are specializing in that space. And of course, when tokenization takes off, and I'm thinking more tokenization, STOs and so on, I think these type of service providers will be very important.
Toby?
Yeah, no, I mean, there's so many, but the data plays I find very interesting, right? The API-free link to something, AllianceBlock's touching it, that kind of thing. A lot of those systems, it's sometimes hard to figure out where the value lies, or if you're getting good value. And Link, for example, has always had a huge market cap, and then trying to understand that. But they're clearly building things and providing. Similarly, Filecoin, very interesting attempt at sort of competing with AWS and Google and the like, which is great. I love like a truly sort of disruptive play in crypto, and Filecoin's very unique. It again has a huge market cap, so it's kind of like a lot of crypto plays. It's sort of almost like the history has arrived as in the valuation, which is always a bit scary, but there's that can also lead to a self-fulfilling prophecy as well, as we've seen, and we discussed Tesla in the call earlier. So I think that's really, really interesting. And then I'm getting increasingly fascinated by all these sort of metaverse plays and how that's popping up, and where, I guess, just because I've been spending a lot of time in the NFT space as well, just where this sort of new crypto reality ends up going, right?
I think that there's a case for play to earn games like Axie Infinity, and the metaverse probably is going to be blowing up soon. We got 1 minute left. I want to thank you, all of you, Efi, Amber, Toby, for joining me today. It's been a real pleasure as always. And I hope to see you again in another webinar, and best of luck to you all.
Thank you.
Thank you.
Thanks.
All right, everybody has been waiting for, I believe, the NFT, the POAP that's coming up. So what you need to do, go to claim.pillar.fi. This is the password. It's Moon. Input your Pillar V2 address. If you haven't, download the Pillar wallet, because we're a non-custodial, smart contract-based wallet. And the final strategy that I have to give to you guys is that it's quite often mentioned is, interact with the ecosystem, because once you interact with the ecosystem, especially with projects that don't have a token, you might be eligible for an airdrop. So please do that. And obviously claim your NFT here. Thanks for everybody joining us. I'm not sure if we're doing a video or not. Are we doing a video? Yeah, we are.
Here's how to claim the Pope NFTs in Pillar V2. I'll go to claim.pillar.fi on my browser. Here, I can type in the secret code given at a Pillar meeting or webinar. Now I can paste in my Pillar V2 address, which I can get by tapping on Receive then Copy Address on my Pillar wallet. Then I just tap on Claim Pope Token, and my new collectible will show up in my Pillar V2 wallet.
My mic is muted. Sorry about that. So please don't miss the upcoming events. Go to pillar.fi//events. And yeah, thank you again for joining us. Our social media is at Pillar Wallet, pillar.fi, and our Discord is at chat.pillar.fi. Join us for another discussion, and I hope you enjoyed the webinar. Thank you so much. Goodbye.